After a deep dive analysis, I decided to sell all my shares of Enbridge. I did more than that. I sold all my Enbridge and TC Energy shares across all our Dividend Stocks Rock Portfolio models. You want to know why? Today's the day, because I'm going to tell you why I sold my shares of Enbridge and why TC Energy not far behind. Dividend investors, bonjour, my name is Mike Héroux and I'm the founder of Dividend Stocks Rock, and I also have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. So Dividend Stocks Rock is a membership website where autonomous investors can use our portfolio models or buy lists or newsletters and attend to private webinars to help them build their portfolio, manage it, and cut down the noise. One of the features is our portfolio models, and as you can see on this graph, we've been doing pretty well. So you can see that the total return for most of our portfolio beat our benchmark, which is pretty much a good sign, right? And I made a major decision in March was to sell Enbridge and TC Energy. So a lot of people will say, well, Mike, they're paying like great dividend. They've been increasing for more than 20 years. So what's your problem? So here's the thing. If you look back in time and look at 3M, everything was perfect between 2008 and 2018, right? The company was growing, they were well diversified across the world. They sell a lot of products that comes with repetitive purchases, which is amazing for stability and income growth. And everybody loved 3M. Not to mention, it is a dividend king, so more than 50 years of consecutive dividend increases. Well, if you've been following 3M since 2018, so for the past 5 years, you can see how everything is falling apart right now. So they are facing litigation, they are facing global slowdown, high inflation, and their dividend is now increasing by 1 penny. We're talking about less than 3% dividend growth over the past 3 years, and not annualized. We're talking about total increase over the past 3 years is less than 1% per year, which leads me to think you better sometimes act a little bit faster than to take too much time, sit on the bench, and then feel sorry about yourself because you thought the stock would be amazing today and for the next 25 years going forward. So that was a very bold move to sell Enbridge and TC Energy because they are loved across the dividend investing community. Actually, when I look at the top 10 most popular stocks at Dividend Stocks Rock, both Enbridge and TC Energy are part of that group. So why in the world am I selling, right? Well, let's take a look at why they are so loved first, and then I'm going to tell you what's going on with TC Energy and Enbridge. So as you can see on this graph, they've done well, but not incredibly well. So they're lagging a little bit behind the TSX 60. So when you're thinking about total return, we're talking about capital gain plus reinvestment of dividends. So even though if you love the dividend and you reinvested it every time you get some, you're still not able to beat the market over the past 10 years, which is not the end of the world if you're a dividend-focused investor, but still you have to know that you're leaving some money on the table. However, one thing that everybody loves, and I'm going to agree with you, is how clockwork they increase their dividend and how the yield is super generous. Right now, we're talking about a yield between 6 and 7%, depending on the time that you're watching this video. So when you're thinking about stable business with pipelines, a lot of cash flow, great dividend growth every single year for more than 20 years. So going through all the oil bust, all the recession, everything that you could mention, and on top of that, you're getting a 6 to 7% yield on your investment. That sounds like the perfect investment for any income-focused investor. But wait a minute, high yield, not that much of a growth over the past few years. We're talking about like 3% increase year after year over the past few years. TC Energy announced that they have reduced their target last year as well in terms of dividend growth policy. So my first question was, is the dividend safe for both companies? So the first reflex you'll have if you have this question is to look at the payout ratio and the cash payout ratio. Well, if you look at that, you're gonna freak out, but you know what? You don't have to worry. The dividend is not as bad as it seems, because now the payout ratio and the cash payout ratio are all over the place, either triple digit or either negative. So in any cases, they're telling you they are spending more money than they're making. So they have to borrow that money to actually pay that dividend every quarter. Is it sustainable? Well, when you look at those metrics, not that much, right? But there's more. So before we establish that we can trust the payout and the cash payout ratio, we must understand the pipeline business. Pipeline business, you pretty guessed it, capital intensive. That means they are spending billions of dollars year after year to maintain and construct new pipelines. So here's the thing. If the business thinks that they're going to generate more cash flow in the future with those investments, they're going to borrow money at a lower rate than what they expect that the new pipeline or the maintenance on that pipeline will generate in the future. So if you do a deep dive in their financial statements, you can look at what Enbridge shows in their cash flow activities. So capital expenditure, 4.6 billion, but they got financing for 7.5. So they borrowed 7.5, and then you're thinking, well, look at the common dividend paid here. It's 7 billion. So they're literally borrowed 7.5 to pay 7 billions in dividend. Well, that's still in line with our theory that the business cannot afford what they're doing, right? So we have to dig a little bit further again. Here's the thing. Enbridge and TC Energy will use what we call distributable cash flow payout ratio. So as you can see here in the investors presentation for 2022 from Enbridge, they have like a bunch of long calculation showing you the adjusted EBITDA, and then they can show you how much they have remaining as distributable cash flow that is available. That cash flow is really the money. So obviously now you have to take on all the amortization and the write-off, and you also have to consider that the company is borrowing money to finance their capital expenditure. And all of that blended together gives a distributable cash flow of 2.6 billion for the last quarter of 2022. And for the full year, we're talking about almost $11 billion. So from that $11 billion, they do pay their dividend and they have plenty of room right there. Now, if you want to have the full calculation and the full explanation on that, because I think I'm going to bore you to death if I continue this way, I've made a full report on why I sold Enbridge and TC Energy in March. So you can download it at thedividendguyblog.com/Enbridge. Just put your email there, you're going to receive the full report for free, and I'm going to explain you everything about the good side and also the bad sides of Enbridge and TC Energy. Now that we have established that the pipelines are safe, they're paying a good dividend, and the growth is still there, so now let's get into the real reason why I sold Enbridge and TC Energy. As you can see here, that is coming from TC Energy 2002 annual report. You can see the difference between what they had paid in terms of debt and what they are getting as new debts for the interest rate. So higher interest rate is real. Obviously, those companies are pretty smart and they have several debts maturity across several years. But every time what you see now is they're paying lower interest rate debts that are being closed and they're getting new one at a much higher price. So by going from cheap debt to more expensive debt, you guessed it, the interest expense keeps going up year after year. So on top of having a business that is capital intensive, that requires a lot of debt to finance their project, now you see that the interest expenses is growing every single year, no matter what is happening, because they have no other ways to get out of that. Now, for those who may think, well, interest rate, it's going to fluctuate and we're going to talk about like dividend cuts anytime soon. Well, you know what? The Fed has been pretty clear by raising their interest rates in May again, and likely by the time that you watch this video, maybe we're on to another increase. But the Fed and the Central Bank of Canada, what they said is we're going to fight inflation until it dies. So we are very far from the time that we're going to talk about maintaining or cutting down the interest rate. In the meantime, both Enbridge and TC Energy are going to issue more debt at a higher interest rate, and then their payment are going to increase. At the same time, what you've seen is both companies have slowed down their dividend growth. What it tells you? Well, it tells you that they starting to lack of growth vectors. Obviously, they're going to sound super positive during their earnings call and going to say that everything is running fine. But what I see here is two major businesses that will pay a good dividend. The dividend is safe, but this is pretty much the only thing you're going to get. And this is why I sold my shares of Enbridge, because I'm going for a lot more than just a nice yield. If I'm getting a yield and I don't get any price appreciation, and at one point the dividend does not increase, or the company runs into more problems, well, the stock price is going to decrease and eventually they're going to cut their dividend. So at this stage, we're not there yet. What I suggest you to do, follow those stocks quarterly. So they fit for somebody that is looking for a stable income, but I would really put them on the radar and making sure that I look at everything all the time. There are a lot of more reasons why I decided to sell Enbridge and TC Energy. It's not just about debts. There's about a lot of other headwinds. The first one is the lack of growth vector. Lack of growth vector because governments right now are very reluctant to approve new pipeline constructions. We see that with the Keystone pipelines that got canceled for TC Energy. We see how Enbridge is fighting over and over across many states, many senators, many people that just say, you know what, I don't want that pipeline in my lake because at one point it's going to spill and then we're going to get stuck with a big mess. So that has become such a highly controversial investment. On top of that, higher carbon tax is going to happen. So they're going to have to modify their system, their pipelines. They're already working on that to become greener options. Enbridge has now like some ways to generate green energy, but it's still a very small portion of their businesses. And you know what it's going to request to make those changes? More capital expenditure. So we're already in a place where those pipelines are racking up debt like there's no tomorrow, and then they will need to even get more debt in the future to make sure that they ensure that transition. So if you want to know more about all the reasons I sold Enbridge and TC Energy, I offer you this free report right now. You can download it at the dividendguyblog.com/Enbridge. You're going to get more graph, more information, more calculation on those things. And I'm also going to share with you my bull case, because there are some positive things also about Enbridge and TC Energy. You're going to find them in the report. I'm curious to know, are you a shareholder of any pipelines? Why do you hold them? And do you really think that they're going to grow in the future, or you're just there for the dividend payment? Let me know in the comment. Let me know what you think about this video. So I'm looking for some interesting debate here. You're entitled to your opinion. I'm entitled to mine, but there's a market for a reason. Some people want to sell, some people want to buy. They go at the market and they make the deal. So I sold my shares. Let me know if you kept yours. I'm curious about that. And until the next video, don't forget to stay invested.